Welcome to the Deep Dive. Today we are diving deep into the Q1 fiscal 2026 earnings call transcript for the company you're interested in, GES. We've taken the full transcript they shared and are going to unpack the latest results, the strategic moves management is making, and their outlook for the rest of the year, pulling out the most important nuggets of knowledge just for you.
So let's jump right into the headline numbers for the first quarter. Total company revenues saw a solid increase, up 9% in US dollars, hitting $648 million. If you strip out currency fluctuations, that growth was even stronger at 12%.
Okay, so a nice jump in revenue. But looking at the source material, it's clear a big piece of that wasn't from their core business organically growing everywhere, right?
Oh, absolutely. The acquisition of Rag & Bone played a huge role.
Right.
The Rag & Bone acquisition alone added about 9 percentage points to that constant currency growth. Remember, this quarter included a full 3 months of Rag & Bone compared to just 1 month in the same quarter last year. So that jump is largely the effect of bringing that full business into the numbers.
Got it. So the core guest business, it added about 3 points of constant currency growth on its own. Where did that growth come from?
That organic growth was primarily driven by a really strong performance in their wholesale operations. They saw good increases in wholesale across both Europe and the Americas.
Wholesale doing well then? Where did they hit some bumps in the road during the quarter?
Yeah, well, they reported softer results in a couple of key areas, Asia, which faced significant challenges we'll get into, and also in their Americas retail channel. There was also a small drag from licensing revenue being down compared to last year.
Despite those headwinds, how did the bottom line look? Did the revenue growth flow through?
Well, they were still operating at a loss for the quarter, which is, pretty typical for their first quarter. But importantly, their operating results came in ahead of their own expectations. They reported an adjusted operating loss of $26 million.
Which translates to?
An adjusted operating loss margin of -4%. So while it's a loss, it was a narrower loss than they had guided for, which is a positive sign relative to their internal forecast.
And looking at it per share?
They delivered an adjusted loss per share of 44 cents. Again, this was an improvement compared to what they expected.
Okay.
So the picture for Q1 is really about the Rag & Bone acquisition providing a big lift, core wholesale showing strength, but significant softness in retail and Asia, although they managed their costs and operations well enough to beat their own profit expectations for the quarter.
All right, let's dig a little deeper into those specific areas, starting with Europe. What stood out there?
In Europe, revenues were up 8% in USD. Or 9% if you look at constant currency. The key driver here was that wholesale business we just mentioned. It saw mid-teen growth in the region.
And management actually called out something interesting about that European wholesale strength, didn't they? Something about supply chain.
They did, yeah. They highlighted their ability to ensure reliable product deliveries to their wholesale partners, even with ongoing global supply chain disruptions like the Red Sea crisis. They framed it not as buying more, but buying earlier to mitigate those risks and get the product where it needed to be on time. That's a tactical win that clearly helped their wholesale performance.
That's fascinating, turning supply chain headaches into a potential advantage. How did their own stores in Europe perform?
European retail stores were a bit below expectations. Comparable store sales at stores open for at least a year were down 4% in constant currency. They saw a decline in foot traffic, but the impact on sales was softened a little because customers who did come in were buying more conversion rates, average unit retail, that's the price per item, and units per transaction were all up.
And the profitability for the European segment?
The adjusted operating loss margin was -2.9%. That was actually lower year over year, which they attributed to some infrastructure spending and currency impacts.
Shifting over to the Americas, let's look at their retail business here in North America.
America's retail revenues grew 9% in USD, 12% constant currency, to $157 million. But again, this increase was primarily thanks to the Rag & Bone acquisition.
So without Rag & Bone, how did the core guest stores do?
The core guest retail business in the US and Canada saw negative comparable store sales. For stores specifically, comps were down 10% in constant currency, and if you include their e-commerce business, it was down 11%.
Ouch. So traffic headwinds are definitely not just a European or Asian problem. They're hitting hard in North America too.
Absolutely. Traffic was a persistent headwind. They did see some offset from improved conversion similar to Europe, and the trend in comp sales did improve somewhat later in the quarter, but the financial impact was significant. The adjusted operating loss margin for America's retail was -10.5%.
That's a much wider loss margin than Europe. Why the bigger hit here?
This decline was mainly driven by what they call deleverage on fixed costs. Think of it this way. When your sales drop significantly in existing stores, fixed costs like rent and utilities become a much larger percentage of your revenue, weighing down your profitability. Plus, they had more markdowns to clear inventory and higher store operating costs, though the rag and bone revenue and slightly better initial merchandise margins helped cushion that somewhat.
Any bright spots on the product side within America's retail?
Yes, women's apparel was a positive contributor, actually showing positive growth of 3%. So that was something.
All right, moving from retail to America's wholesale. This segment looked much stronger, driven by rag and bone again.
Significantly stronger. America's wholesale revenues jumped 63% in USD or 70% in constant currency, reaching $11 million. Yes, Rag & Bone's wholesale business was a major driver here, alongside higher shipments of core guest product, including to off-price accounts. The adjusted operating margin for this segment was 19.9%, which was a bit lower year over year due to the mix shift from including the Rag & Bone business, which operates at a different margin profile. They expect this wholesale business to see modest growth for the full year.
Now, let's talk about Asia. The numbers looked quite weak there.
They did. Revenues in Asia decreased significantly, down 20% in USD, 16% in constant currency to $58 million. The weakness was particularly acute in the Greater China market, where revenues were down over 20%.
And it sounds like the company is making some pretty drastic moves in China because of this.
They are. Management explicitly stated they are actively contracting their operations there. This involves headcount reductions, store closings, and stopping future product purchases for that market. They are also actively looking for a partner to take over the business there entirely. They highlighted that this business lost roughly $20 million this year, and their goal is to completely eliminate that loss in the next fiscal year through this exit partnership strategy.
So a strategic pivot to stop the bleeding in a challenging market. What about their licensing business?
Licensing revenues declined 14% year over year, coming in at $25 million. This was mainly due to declines in their fragrances and footwear licenses. However, their handbag licensing business actually saw growth.
Given how much the Rag & Bone acquisition is influencing the overall numbers, what specific updates did they give on that brand's performance and plans?
Rag & Bone significantly outperformed their own expectations in Q1. This was primarily driven by stronger than anticipated wholesale shipments, but retail and online performance were also strong. They shared their plan for Rag & Bone this fiscal year is to generate over $320 million in revenue, which is a substantial increase from the roughly $250 million annualized run rate the brand had before the acquisition.
That's a big jump. What's the plan to achieve that beyond just owning it for the full year?
Several growth vectors. They are physically expanding its footprint. They've gone from 38 stores at the time of acquisition to 41 now and plan to open over 10 more soon. They're also seeing same-store sales growth and organic growth in Rag & Bone's wholesale business. Plus, they're adding new international markets like Europe.
Right, you mentioned Amsterdam.
Exactly. They just opened in Amsterdam and Germany is next. And expanding their presence in places like Korea.
And bringing in new product categories through licensing, like they do for the core Guess brand.
Exactly. They mentioned handbags are already doing well under a new license, and they have watches, fragrances, and eyewear licenses in development for Rag & Bone. They're also strengthening the internal team supporting the brand, hiring a new CMO and head of HR. One particularly interesting point was about their outlet business model for Rag & Bone. They've shifted from using excess inventory to making products specifically for outlets, expanding that distribution, and they described the outlet business there as being on fire.
Wow, okay. On fire. That's quite a description. Okay, let's zoom out and look at the financial structure of the overall company. What happened with their gross margin?
The total company gross margin came in at 39.9%, which was 200 basis points lower than last year and also below their expectation.
Why the drop in margin?
The main driver, accounting for about 70% of that change, was business mix. They had lower contributions from high-margin royalty income and a higher contribution from the wholesale business, which naturally operates at lower product margins compared to retail or licensing.
Okay, that makes sense.
There was also a modest headwind from increased promotional activity, meaning more markdowns to clear product. But they managed to fully offset that impact with improvements in initial merchandise margins, basically, buying the product at a slightly better cost. Currencies also had a small negative impact on margins.
And their operating expenses, SG&A.
Selling, general, and administrative expenses, SG&A, increased 11% year over year, totaling $285 million. This was primarily driven by the integration costs and expenses associated with bringing Rag & Bone into the fold for a full quarter. As a percentage of revenue, the SG&A rate increased 80 basis points to 44%.
Tariffs are a hot topic right now, especially with trade policy shifting. How are they impacting this company?
Management clarified that about 75% of their business is outside the U.S., so that portion isn't directly impacted by U.S. tariffs. For the remaining 25% of directly produced and distributed products that are subject to tariffs, representing about $200 million in annual purchases, they've been taking steps. This includes moving a substantial amount of production out of China, renegotiating costs with their vendors, and adjusting pricing with their retail customers.
So what's the net financial impact they're anticipating from this?
They expect the year-over-year impact of tariffs on their margins this year to be less than $10 million. They stress that this impact is fully incorporated into their financial outlook, and they've managed it with minimal need for price increases to their customers.
Interesting.
Yeah, they didn't really comment on how broader tariff-related fears about inflation or recession might affect overall consumer spending, focusing only on the direct cost impact to them.
Now let's pivot to the future. What are the big strategic initiatives they're focusing on to improve performance and tackle some of these challenges, like the retail traffic problem?
Their highest priority is retail productivity. This is directly addressing the persistent traffic decline they've seen in their stores and online, particularly in the US and Asia, and now starting to show up in Europe.
How are they planning to get people back into stores and onto their sites?
They're significantly increasing their marketing investment. They've hired a consulting firm to help develop a new market vision and social media strategy, led internally by Nikolai Marciano. This involves restructuring their marketing teams, adopting new practices, and investing more heavily in social channels, influencers, and collaborations specifically to attract a younger audience.
And the loyalty program seems key too.
Absolutely. They highlighted the early success of their customer loyalty program, which they've piloted in Italy and Poland. They reported positive results with loyalty customers spending 36% more and visiting more frequently. The plan is to roll this out to Germany, Austria, and Spain next, then other markets. They're also investing in AI-powered tools to get better customer insights.
They also talked about changing how they actually buy inventory for the stores. That sounded important.
Yes, that's a key part of retail productivity. While they've improved initial merchandise margins by making larger, earlier commitments, they acknowledge this can sometimes mean missing out on emerging trends later in the season. So they're developing fast-track capabilities. The goal is to be able to quickly replenish bestsellers and introduce new product based on real-time trend data. For their Spring-Summer 26 collection, their goal is ambitious. Leave 50% of their buy open after initial orders to react to demand and trends.
50%, wow. And they're adjusting their pricing strategy too.
Correct. They're looking to rebalance their product assortment to have a higher penetration of opening price point products. They commented that their past strategy of elevating brand quality through better materials might have priced out some longtime customers, and today's consumer is particularly sensitive to pricing, so they need those entry points.
Makes sense.
Finally, for retail, they're making their store clustering model less rigid. This means giving store managers more flexibility to decide what product assortment works best for their specific location, considering things like local customer types and even weather patterns, rather than sticking strictly to a centralized, rigid model. They'll also be challenging how much space certain product categories get based on expected sales productivity in that store, and improving the look and feel with updated visual merchandising.
Management quantified the potential upside of these retail efforts, didn't they? That seems important.
They did. They estimated that a 10% improvement in company-wide retail sales could translate into approximately $140 million in incremental revenue and a significant $70 million in incremental operating profit.
That's a big number.
It is. And they mentioned that early reads on these initiatives in North America and Europe are encouraging, and they're already seeing sequential improvements in conversion rates and retail comps in Q2 so far. So maybe some early green shoots.
Okay. Beyond fixing the core retail experience, the second major strategic area is rationalizing the business model. What does that involve?
This is about constantly evaluating the profitability of their entire portfolio, looking at which channels, product categories, and markets are performing and which aren't, and making tough decisions. This includes looking at their store portfolio. They plan to exit non-strategic and unprofitable full-price desk stores in North America, aiming to reduce that fleet by roughly 20 stores, with 6 already closed this year.
And their plans in China fall under this rationalization.
Absolutely. The plan to exit or find a partner for the China business is directly aimed at addressing an unproductive business that lost them about $20 million this year. Successfully exiting that market in the next fiscal year, combined with the North America store closures, could unlock over $30 million in operating profit. They're also examining other underperforming product categories, customer relationships that aren't profitable, products that don't sell well, SKUs, and consolidating their global product development efforts, including for their outlets.
The third big strategic bucket is infrastructure alignment. It sounds like they need to modernize how the whole company is structured. After all, it started back in '81.
Yes, this is a major undertaking. The company started in 1981, and the structure has grown organically and become quite complex. They see opportunities to re-engineer their support structures, potentially consolidating functions currently split between Los Angeles and Lugano, Switzerland, into one global center to improve efficiency.
Right.
They also need to realign their complex European structure, which operates across over 35 countries. The plan is to centralize strategy setting regionally while leaving execution to the local in-country teams.
And logistics is part of that optimization.
Yeah.
Getting products around more efficiently.
Definitely. They operate 8 logistics centers in Europe and 3 in North America. They see opportunities to consolidate and optimize these networks within each region to improve efficiency and reduce costs.
Makes sense.
Finally, a big piece of the infrastructure puzzle is their IT systems. They plan to restructure and re-engineer their system environment to create a more uniform and standardized global IT network, moving away from the current setup where different parts of the business use different disconnected solutions.
So the overarching goal with this infrastructure work is to build a more unified global platform that makes the company more agile, efficient, and strategically aligned. That's a huge effort happening alongside trying to fix retail and rationalize other parts of the business.
It really is. It highlights the scale of the transformation they're attempting across the entire organization. It's a lot.
Let's wrap up with the outlook for the rest of the year. How did this quarter's performance and trends impact their financial guidance?
They updated their full-year outlook, but it only reflects modest changes based on the Q1 results and trends. They still expect full-year revenue growth between 5.5% and 7.4% in U.S. dollars. The key drivers for that growth remain the full-year ownership of Rag & Bone, continued solid growth in European wholesale, and the conversion of their Middle East business to a joint venture. However, they have slightly moderated their expectations for European retail and Asia based on the Q1 performance. They also anticipate a slightly stronger currency tailwind on revenues than previously expected because the U.S. dollar has weakened recently.
And what about their profitability expectations for the full year?
For the full year, they are guiding for an adjusted operating margin between 4.4% and 5.1%. Their outlook for full-year adjusted earnings per share is in the range of $1.32 to $1.64. They confirmed that this full-year guidance fully absorbs the anticipated tariff impact they discussed, which is less than $10 million on margins.
Did they provide specific guidance for the second quarter?
Yes. For Q2 specifically, they expect U.S. dollar revenue growth between 2.9% and 4.7%. In constant currency, that translates to roughly 2% to 4% growth, including about a 1 percentage point tailwind from currencies. They noted that Q2's is the first quarter where they will have owned Rag & Bone for the full period in both years, so there won't be an acquisition growth bump this quarter. The growth is expected to be organic core growth plus Rag & Bone's organic growth, aligning with the roughly 3% core organic growth rate seen in Q1.
Okay, so that Q2 growth number is more representative of the underlying trend then.
Pretty much, yeah. For Q2 adjusted operating margin, they expect between 2% and 3.3%. They anticipate this will be lower year over year, largely due to higher occupancy and SG&A rates caused by the negative retail comparable store sales, reducing revenue relative to fixed costs. Their adjusted Q2 EPS outlook is between 11 cents and 31 cents.
And management is expecting those retail trends to improve later in the year, right? Banking on those initiatives kicking in.
They are anticipating some improvement in the second half of the year as the marketing investments and retail productivity initiatives they outlined start to gain traction and show results. That's the hope anyway.
Finally, what's the outlook for free cash flow?
They are still expecting roughly $55 million in full-year free cash flow. This includes about $65 million in capital expenditures, which are likely tied to some of those infrastructure and store-related strategic initiatives. They believe any changes in the earnings outlook will be offset by tightening their working capital, managing inventory and receivables more efficiently.
And a quick final note. They announced a new CFO starting.
Yes, Alberto Toni has joined as the new CFO, based in Lugano, Switzerland. The interim CFO, Dennis C. Core, will remain until September 2025 to ensure a smooth transition period.
So reflecting on all of this information from the transcript, you've got a company that's clearly leveraging a recent acquisition to show top-line growth while simultaneously trying to tackle some pretty fundamental challenges. Persistent traffic declines in key retail markets, underperforming segments like Asia, and an infrastructure built up over decades that needs modernizing.
Yeah, it's definitely a company in transition. They're balancing protecting their immediate business through tactical supply chain moves and focusing on high-performing areas like wholesale and rag and bone, while attempting these large-scale, complex strategic shifts aimed at improving retail productivity, rationalizing their global footprint, and building a more efficient foundation for the long term.
It's a classic case study in an established brand navigating the current retail and global business environment. All these initiatives, the marketing push for younger consumers, the shift to more opening price points, the effort to get the right product into the right stores at the right time, the exit from losing businesses, they're concrete actions companies are taking right now.
Absolutely. And the focus on mitigating tariff impacts with minimal price increases shows how sensitive they are to the current consumer environment while trying to protect margins.
This deep dive has given you a lot to think about. You've got the headline numbers, the performance across regions, the key strategic priorities, and the outlook.
It's clear management has a detailed roadmap for addressing the challenges and driving future value, but these are significant, complex changes they're juggling.
Here's something to consider as you mull all this over. Given the ongoing pressure on consumer traffic and retail, and the fact that big strategic initiatives like marketing overhauls and infrastructure changes take time to yield results, how quickly can a company of this size realistically execute on all these complex plans simultaneously and translate them into sustained, meaningful improvements in profitability and consistent organic growth, especially in a potentially uncertain economic climate?
It's a really good question. It's a question of execution speed and, well, market timing, isn't it?
And as a reminder, this discussion is based solely on the information provided in the company's earnings call transcript. This is not financial advice.
Always do your own research and consult with a financial professional before making any investment decisions.
Thanks for joining us for this deep dive.